Therefore, these 4 solutions are to solve the adverse selection problem. Produce private information, the first one, but that causes a free rider problem. The government comes to the rescue with the regulations, but business hates regulations. Therefore, financial intermediaries comes to the rescue. And remember, adverse selection problem is the problem before transaction occurs, before you buy the used car, before you lend out your money. You do all those things to give the lenders the incentive to not to withdraw from the market, to lend you the money. Next, let's talk about how we can solve the moral hazard problem. Well, we want to separate the solution into 2 parts. The first part is to solve the moral hazard problem in the stock market. The second one is to solve the moral hazard problem in the bond market. Okay? The moral hazard problem in the stock market is also called principal agent problem. You buy stocks. Therefore, you are one of the owners of the company. You are called principal. Then you hire CEOs to run the company for you. And they are called the agents because you, principal, hire the agent to run the company. Whose money is it? Your money. You own the company. The CEOs, they don't own the company. They are hired by you to run your money. A very interesting example is on this New York Times article. Okay? An East Coast company just hired in 2007 a new CEO from a West Coast company. But the CEO has a high school daughter in her senior year in high school. And she did not want to go to a new school in the East Coast. Therefore, the CEO used the company private jet, the company jets, to transport her daughter from East Coast to West Coast to go to high school for 1 year and then flew her back every day. If you own the stock of this company, are you happy? No. The CEO is doing something that you didn't want him to do after you hire him. So this is the moral hazard problem in the stock market. So how can you solve this problem if you buy the stocks of this company? The first one is you hire somebody to the company to monitor what the CEO is doing. Did he put some Picasso painting on his office wall? Is he getting a huge office? Is he doing something that you don't want him to do? If the person who you send to the company finds that the CEO is doing something that you do not want him to do, then he will report to you. But the problem is, you own 100 shares of this company. You may think that somebody else owns 1,000 shares. So he cares more than I do. So he will send somebody there. I'm not going to send somebody there. I'm not going to hire somebody there. And the person who owns 1,000 shares of the company will think that, well, somebody else owns 2,000 shares and she cares more than I do. So she will send somebody there, hire somebody there to monitor the company. I don't have to. That is, everybody wants to be a free rider. So again, the free rider problem prevents this solution to be a good solution. What can we do? Well, government comes to the rescue if nobody wants to do it. And again, in a country like the United States, business hates the government regulation. And the government needs business. Therefore, government regulation will not work very well. Then here comes the financial intermediaries. The financial intermediaries can help to solve the principal agent problem. That is, you put money in the financial intermediaries and they collect the money and they can send somebody there to monitor the company, or they can have some expertise. They can hire some experts to monitor the balance sheets of the company because of the economies of scale. That can solve the principal agent problem. The final solution is kind of a cop-out solution. What is that? If you don't want to have a principal agent problem and you are a principal, what can you do? The answer is not becoming a principal. That's why I call a cop-out solution. If you don't like principal agent problem, then don't be a principal. That is, you don't buy stocks. You don't want to be an owner of the stocks. Instead, you buy bonds from the company. Then the company will give you a fixed payment every month. You don't have to worry about whether the company is operating normally or abnormally. But does that mean there's no problem if you buy bonds instead of stocks? The answer is no. Next, we want to talk about the moral hazard problem in the bond market. Even if you buy bonds instead of stocks, you still face moral hazard problem. Remember, moral hazard problem happens after transaction occurs. Therefore, moral hazard problem in the debt market, you have already bought the bonds. Remember, if you buy a bond is a contract. When you buy the bond, you know all your future cash inflows. GE issue a GE bond. When you buy the bond, you know that how much money you are going to get every month for the next, say for example, 36 months. $100, $100, $100, $100. No matter what happened to GE, whether they operated well or badly, you always get $100, $100, $100. Unless GE goes bankrupt. So if you buy a bond, the only problem you will face is when the company goes bankrupt. Alright, when the company goes bankrupt, what can you do? Well, the company is going to sell all their assets, pay off their liabilities. What's left is net worth. Therefore, if you want to buy a bond, you want the net worth to be bigger. If the company has a negative net worth, that is, their debt is bigger than their assets, then as a debt holder, you may not get your fixed income payment. So if you are a debt holder, the problem you are facing is when the company goes bankrupt and you are not going to get your money back. Therefore, in order to solve this problem, the company will have to keep a bigger net worth so that the net worth will not go negative. That will give the investors incentive to buy their bonds. The second solution is to monitor and enforce the restrictive covenants. What are the restrictive covenants? I'll give you an example. What is the restrictive covenants of the home mortgage? The answer is, if you borrow a mortgage, the mortgage company is going to ask you to have full insurance on the house all the time. This is called restrictive covenant because it's their house, it's not your house. You borrow their money to buy the house. Then what is the restrictive covenant of your car loan? The answer is, the car loan company is going to ask you to have full coverage of your car insurance at all time before they give you your car title back. That is when you pay off your car loan. So these are the restrictive covenants. Also, financial intermediaries can help to solve moral hazard problem in the bond market. So you don't buy bonds directly from the company. You put money into the bank buy bonds from the company. That will help you to solve the moral hazard problem. With the understanding of all the information that we have learned in Chapter 8, now we can talk about the 8 basic facts of the financial markets. If you have an older version of the textbook, the author of the textbook used to call these 8 puzzles of the financial market. But he changed puzzles to facts. Because if you understand what we have been talking about in this chapter, these things are actually facts. They are not puzzling at all. Okay? The first fact is, if you open a Wall Street Journal, okay? Most of the news are about stocks, stock markets. Why do stock market exist? The answer is to transfer funds from the stock buyers to the company, the corporations. Okay? So stock market is where the company borrow monies from the lenders. And they are on the news. So it seems to us that stock market is the most important source of external finance. It's the most important place for companies to borrow money from the lenders. But the answer is no. Stock market are not the most important source of external finance. Why? Well, let's look at the first fact. In the United States, only 11% of the money raised by companies is from the stock market. And this is not just for the United States. In Germany, the German companies only raise 8% of their money from the stock market. In Japan, only 5%. In Canada, 12%. Therefore, stocks are not the most important source of external finance. So where do companies borrow money from? Is it bond market? The answer is no. The second fact is marketable securities are again not the primary funding sources for companies. What are marketable securities? Marketable securities are the securities that can be traded in the market. Therefore, marketable securities are bonds plus stocks. They can be traded. Okay, now let's look at this. In the United States, 32% of the external funding of the companies are from the bond market. So 32 plus 11 is only 43%, not the majority, lower than 50%. In Germany, only 15%. In Japan, only 14%. In Canada, only 27%. So where do companies get their money from? The answer is from the financial intermediaries. Look at this. In the United States, companies get 57% of their money from the financial intermediaries, from the commercial banks or from the non-bank financial institutions like mutual fund company, life insurance company, mortgage companies. Okay? In Japan, more than 80%, more than 85% are from the financial intermediaries. In Germany, 88%. In Canada, 74%. Why? Because financial intermediaries help to solve the transaction cost problem and the asymmetric information problems, the adverse selection problem, and moral hazard problems. Financial intermediaries can help to solve these problems that cause financial market to fail, that cause fund suppliers to withdraw from the market. Therefore, most of the financing is going through financial intermediaries. Therefore, indirect finance is much more important than direct finance. Usually, lenders do not lend money directly to the borrowers. They put their money in the financial intermediary, and then borrowers go to the financial intermediaries to borrow money from the financial intermediaries. There is also a change of the roles of the financial intermediaries before and after the financial crisis in 2008-2009. As you can see, remember 3 types of financial intermediaries: depository, contractual, and investment. Now, a lot of money are borrowed from the investment intermediaries and the contractual savings bank. The change is huge. That is why right now in the United States, a lot of money are borrowed from non-bank loans. The last two types of financial intermediaries become more and more important. That's the first 4 facts of the financial market. Now, let's see the rest 4. Number 5. Financial system is the most heavily regulated industry in the United States and in the world. Why? Because fund suppliers have all the reason to withdraw from the market. Therefore, the government will have to put a lot of regulations to protect the lenders so that the lenders are willing to lend their money to the borrowers, to the entrepreneurs. And only large and well-established firms can issue bonds and stocks because people are going to buy stocks and bonds from only large, well-established firms, which have bigger net worth. Number 7, collateral is very important. For all the debt contracts, you always have to put some collaterals to solve the moral hazard problem in the debt market. Number 8, debt contracts are extremely complicated. The documents have a lot of restrictive covenants. If you are going to the closing date of your mortgage, you are going to sign your signature 100 times, more than 100 times. Why? You have to sign a lot of your name because there are a lot of documents for you to sign. The debt contracts are extremely complicated. Why? To protect the lenders. And restrictive covenants like your home insurance and your car insurance.